Just when we thought things were calming down, the US-China trade war has absolutely roared back to life, and it sent some serious shockwaves through the global markets. So in this explainer, we're going to break down exactly what triggered this sudden flare-up and, what it could mean for all of us.
So, the week kicked off with this real sense of dread in the air. As Asian markets were getting ready to open, you could just feel investors bracing for what a lot of analysts were calling a massive catchdown. I mean, after the weekend we just had, full of escalating threats, a big sell-off felt almost guaranteed. And you could actually put a number on that fear. Right away, pre-market indicators for Hong Kong's Hang Seng Index were already pointing to a drop of 2.5% right at the open. The mood on the trading floor was officially risk-off.
But look, this wasn't just some Monday morning panic. This was a direct reaction to news that dropped late on Friday. You see, trackers for Chinese stocks had already taken a massive hit in U.S. trading. The broader CSI 300 was down around 4.5%, but the tech-focused Crane Shares ETF, down a staggering 9%. And that tells you everything you need to know. This escalation was laser-focused on technology.
Okay, so let's start with the immediate fallout. Section 1, Markets in Turmoil. We're going to unpack that initial shock just to see how significant it really was.
So the big question is, how did we even get here, right? How does a 4-month trade truce just collapse into a market spiral in a matter of days? To figure that out, we've got to look at the timeline of how this all went down. And that brings us to our second section, a weekend of threats. We're going to rewind the clock a little bit and look at the rapid-fire sequence of events that really set the stage for Monday's market chaos. This timeline just shows how incredibly fast things spiraled out of control. It all started about 10 days ago when the U.S. expanded its entity list. That's basically a blacklist for companies getting U.S. tech. Then boom, over the weekend, threats of doubled tariffs and software curbs. China, of course, fired back on Sunday, warning of retaliation. But then by Monday morning, the tone softened just a bit, with the door open for a deal. I mean, what a dizzying 72 hours.
And this quote from President Trump, wow. It just perfectly captures the combative tone that spooked investors. Even while he was praising President Xi in other places, this something much tougher rhetoric, it signaled a really sharp escalation and just created this massive cloud of uncertainty.
So this whole escalation, it pulls back the curtain, It shows that this conflict is about way more than just tariffs. This brings us to Section 3, the tit-for-tat war. We're talking about a deeper, strategic battle being fought right in the middle of the tech sector.
Okay, let's break down the strategies here, because it's pretty fascinating. The U.S. is using something called the Foreign Direct Product Rule. It basically lets them restrict China's access to critical tech, like semiconductors, even if that tech is made outside the U.S. So how does China counter? Well, they're using their dominance in key materials, hitting back with new export controls on any goods that have even trace elements of Chinese stuff in them. Each side is hitting the other where it really, really hurts.
And this is where a really key idea comes into play. Long-arm jurisdiction. For years, the U.S. has used this concept to extend its own rules across the globe. But what's happening now? China is doing the exact same thing with its new export controls. This is their strongest attempt ever to project their own rules beyond their borders. They're literally using the American playbook.
And believe me, China's playbook doesn't end with export controls. They have other powerful levers to pull. They can disrupt supply chains for huge companies like Apple by making it harder for them to work with key contractors. They can also use access to their massive domestic market as a weapon, which is a really powerful tool against sensitive U.S. industries like agriculture. Retaliation, it turns out, can come in a lot of different forms.
So with all this chaos flying around, how are the experts even making sense of it? That brings us to our final section, crisis or opportunity. Let's take a look at how Wall Street is trying to read the tea leaves.
And what's really wild is the total lack of agreement on Wall Street. I mean, look at this. Goldman Sachs sees a huge range of possibilities, everything from new restrictions to even lower tariffs. Nomura thinks it's all just posturing before the big APEC meeting. And then you have JP Morgan, who sees a potential buy-the-dip opportunity here. This complete split really just highlights the incredible uncertainty everyone is facing. This split really creates a tough spot for investors and for business leaders. So where does that leave them? I mean, do you run for cover? Or do you lean into all this volatility?
All right, first up, here's the bullish tick. The CIO of Lotus Asset Management says he sees this market dip as the exact chance he's been waiting for, a moment to buy into a market that he thought was running too hot. For him, this chaos is actually an opportunity.
But then, on the complete other side of the coin, you have the view from the real economy. Business leader Martin Sorrell points out the chilling effect of all this tension. He argues that uncertainty is just poison. It makes businesses stop, it makes them postpone decisions, and that is just not good news for growth.
And that leaves us with the million-dollar question that everybody is asking right now. With the APEC summit just weeks away, where the two leaders could actually meet, are all these dramatic moves just high-stakes poker? Or are we entering a fundamentally new, much more unpredictable and volatile phase of this conflict? The whole world is going to be watching to find out.